Welcome to the Rebellious Times podcast, where we explore the intersection of human ambition and technology. I'm your host, Chris Januszewski. In each episode, we dive deep with founders, innovators, and thought leaders who are reshaping how we build, scale, and work in the AI revolution. And today, I am delighted to introduce to you Sanjay Nishak, a technical founder with deep fintech and banking experience. His company is called Intane. Intane builds intelligent blockchains for transparency and efficiency in capital market transactions with initial focus on asset-backed investments. Sanjay, how are you doing today, sir?
Hey, I'm good, Chris, and it's great to be here. Really delighted to be part of your podcast.
Thank you. Delighted to have you on. You've got a really fascinating background and found a lot of success with your business in opening up doors of large institutions in a complex space. So how about we start with a little bit of a background about you, your journey, and how you moved from IT services to entrepreneurship?
Sure, Chris. So I I'm an electrical engineer, and I passed out my engineering degree around 22 years ago. Then I completed my management degree from one of the topmost management colleges in India. I spent around 15 to 16 years after passing out from my management in working with large IT services companies, primarily in dealing with large financial services clients. Again, I spent around 3 years in working with large mortgage banks in US. I was based out of West Coast for some time in California, and I was also in New York for some more time. Beyond that, I spent 3 years again in UK, again working with one of the large mortgage banks, which was Halifax Bank of Scotland. At that point in time, it's already taken over by Lloyds now. And I spent another 3 or 4 years in Switzerland working with Credit Suisse. Most of the time I have spent in this first 15 years of my journey was working with financial services companies, rolling out large enterprise software products, doing business development, and doing some amount of financial services consulting. Now, so this is what I did for the first 15 years of my life. Beyond which I kind of realized that I had to do something on my own. So in 2015, I left one of my existing jobs, and then I got together with three of my friends in India. We set up a company called Grex. Grex was a private placement platform. We wanted to build something which was similar to a public exchange, but which is available for the small private companies to raise capital. So at that point in time, which was in 2015 or 2016, the regular way of raising money for a small private company was talking to the angel investors and then doing all those coffee talks and then raising money. But then we wanted to bring in the typical public exchange infrastructure, which included registrar and transfer agent or custodians or depositories infrastructure, and integrate all of that to a private company fundraising ecosystem. We built a platform called Grex at that point in time. We raised a couple of rounds of capital from quite a few angel investors. At that point in time, it was around 80, so it was kind of unimaginable. So we raised money from 85 angel investors. And then we did investment through the Grex platform into 10 or 15 companies. So we got investments of around $5 million into those 10 or 15 companies as the pre-seed round.
Can I ask, 85 angel investors, does that mean you had individual conversations with 85, or did they kind of come together as a group to invest?
Yeah, so this was completely like I said, this was 2015, and the existing way of raising money from angel investors was actually talking to them and then probably getting all those investment memorandums kind of customized to individuals' requirements. All of this, the profile of these people were completely different. Some of them were completely new to investing in startups, and some of them were we're pretty mature people, coming from the CEO or CXO level of a large financial services companies. But then that was how it was working in 2015, and so we kind of went ahead with that. But we were able to raise money from 85 people. What that told us is that there was interest in terms of people to actually invest in a platform which can make it easier for other private companies to raise capital. So that kind of told us that they understood that the system was broken and they wanted to fix it by creating a new platform, which is why they probably invested in us. So this is what we kind of did around for 4 years, and at the end of that 4 year time period, that's when all this Bitcoin was there in the market, and people started talking about investing in Bitcoin and then mining for Bitcoin and Ethereum. So that's the point in time when I got in touch with this blockchain technologies, and then I wanted to understand more. I started getting a little more hands-on in that, in terms of developing a smaller dApps using Ethereum platform. I also had set up my own mining infrastructure in India, in the western part of India. But obviously, I ran it for around 1.5 years, but the energy cost was so expensive that it actually defeated the purpose of mining out of India. So mining ether out of India. So and I also figured out that probably blockchain technology was one of the ways which can be utilized to build certain automated workflows. So, for example, how I understood the utility of blockchain technology is that we used to gather information about, as part of Grex, we used to gather information about these private companies, and we used to maintain central databases like typical investment banking platform. We used to maintain that in data rooms. It's called data rooms. So what I realize is that since these are all private companies and smaller private companies, and people do not usually angel investors or new prospective investors would never trust this kind of data, because these are all smaller private companies. So we wanted to build a blockchain platform where we would maintain all of this data and the corporate action events from these smaller private companies in a blockchain network. So that was my the first use case which I thought can actually use a blockchain technology in the backend, and which can actually increase the trust and transparency of that data being maintained and being available to the investors. So that's how I actually came to know the uses and utility of blockchain technologies. But then there was so much required to make it scalable. So which actually happened in my second venture when I got along with Siddharth in working with my other founder in working on Intain. When we founded Intain in 2018, so we wanted to work in an environment or in an industry which was actually taking a lot of time. There are so many entities which was involved in that industry. So I'm talking about the structured finance industry. Essentially, if I can just talk in two or three sentences about what usually happens in a typical lending scenario, any originator or any loan originator usually lends money to a borrower, and once they have sufficient amount of loans being lent, they usually pool that and sell it to a different entity which is called an issuer, and that particular entity issuer usually creates multiple categories of instruments, fixed income, typical fixed income type of instruments, and then sells it to institutional investors. Institutional investors are a little more interested in investing in this kind of instruments, because these instruments are backed by actual loans in which there are EMIs or there are payments which are being made by the ultimate borrowers month on month. So that's what, and this process is called securitization of loans. So typically the originators originate the loans, pool it, sell it to another entity called issuer. The issuer creates different tranches or different categories of fixed income kind of instruments and sells those into institutional investors. So
Got it.
if people actually know about it, they would have probably if people would have seen this Big Short movie, they probably that's what typically happens in this kind of workflow. And it's a pretty long workflow. It takes around 45 days to complete from start to finish. There are quite a few entities involved. There are at least 12 or 13 entities involved in completing this flow from end to end. So it takes a lot of time. So that's the industry where we wanted to implement blockchain technology and create efficiencies both in terms of cost as well as reduce risk in terms of running the flow.
Okay, so why did this process take so long? It sounds like you've identified a real issue here with loans taking 45 days. Kind of how does Intain's technology and service improve this, and what was the underlying issue that you came and fixed?
Yes. I think it's interesting that so how we came up with this problem statement is that in India there are typical companies which are not banks and which are called non-banking financial companies, NBFCs. So typically what they do is these are all small institutions. So they raise some money from the normal size banks which are regulated by the Central Bank of India. And they raise that money and then they actually lend it to different borrowers to buy bikes, this two-wheelers. So the NBFCs, non-banking financial companies, they take money from the bank and then they lend it to individual borrowers so that those borrowers can actually buy bikes and then keep making monthly payments. It's like mortgage loans, but then these are against bikes. But all of this process, and once they lend the money, they usually appoint someone else to collect the payments, and then once collect the payments on a monthly basis. Once the monthly payments are collected, then they have to actually figure out what portion of that money should go to a servicer or to them or to the bank as interest payment from whom that NBFC had taken the loan or had taken the money in the first instance. So this is kind of a smaller size businesses, and they were facing so much a problem in terms of completing this. And since there are so many entities, they always maintain the data in Excel sheets or emails. They keep sending emails or Excel sheets, sharing the Excel sheets along with each other. The data reconciliation itself takes such a lot of time, because if one operation guy of one entity is let's say on vacation and is not available, then it actually gets delayed such a long period of time. So typically, it typically takes such a long period of time because of 2 or 3 reasons. One is that there are so many entities involved, right from the point of originating those loans till the time that you collect those monthly payments, and then decide what percentage will go to what entity, and then finally actually making all of those bank transfers, and at the end of it create a report at the end of the month saying that, hey, this is the amount that we received and this is how it has been distributed. So that's one important reason why it takes such a lot of time. Too many people, the data being shared between each one of them as part of Excels or emails. Then the reconciliation itself takes such a lot of time because there are different databases that different databases do not talk to each other. So it's a real problem, and it happens for a large organization. A large organization who generates multiple millions of dollars of mortgage loans a month, or it also happens for smaller organizations like the example which I gave, for smaller non-banking financial companies which actually lend money to borrowers to buy their two-wheelers. So that's the basic problem that we actually wanted to address using blockchain technologies.
Okay, and so how does blockchain impact this, and how do you layer in AI to complement the blockchain and build this architecture that helps your clients?
Right. So what I think, like I just talked about the pain point. The pain point was that there are too many entities, and the second pain point was that the kind of data that they keep collecting or maintaining in the databases. Uh, so they have to be reconciled against each other. So what we thought is that if I mean blockchain technology in its inherent capability, it actually creates a it creates a fundamental data rail. It's a horizontal data rail. It provides, which can be utilized by multiple entities as long as we can authenticate or authorize each one of those entities. They all can work on the same digital data rail rather than maintaining different databases in their own infrastructure or own systems. So blockchain, in an as an inherent technology, it actually provides that a common data rail or common digital data infrastructure, which we call ledger in the blockchain technology space. So that's what we actually wanted to do initially. But the other thing we are also pretty cognizant about was that these are all private data, because these are all large banks and they do not want to actually share this data with any other competitors or any other industries. So we initially, when we created a product which was called Inten Admin in 2018 or 2019. So we actually used Hyperledger Fabric, which is a private permission blockchain network. So essentially, we set up the complete infrastructure from end to end using Fabric, and one of the primary entities which can operate on this network was the trustee. So trustee is an anchor entity as part of this securitization lifecycle, which is responsible for taking coordinating with the transaction account, which is used by the servicer to collect payments from individual borrowers, and then running a payment waterfall calculation. So trustee is responsible for running that payment waterfall calculation and deciding what percentage or what amount will go to a servicer, what amount will go to the individual originator or to an investor who has actually bought into those ultimate units. So we actually give access to the trustee to operate this network. So as that was the anchor entity. So what we realized, or what we found out, is that since trustee can work on this, if the servicer Excel sheets are already available, which includes the payments which have been collected from individual borrowers, the trustee can all those data can actually come into the blockchain ledger. They can be saved into the blockchain ledger, where it's tamper proof, and nobody can actually make any changes to that data once it's saved into the ledger. Then the trust, so that's one part, which is how we actually get the data. And secondly, once we get the data, then we can use the smart contracts to run payment waterfall calculations on that data, and which is being actually performed by trustee. And then based on that payment waterfall calculations, whatever amount has been decided, it can the trustee can create a report just based on that investor report. We call that investor report. And based on that report, the amounts can actually be transferred to different entities. Now this is what happens as far as the blockchain technologies is concerned. But I think the other part which we also brought in, which was kind of innovative, and we which created some amount of value into the overall workflow, was the implementation of the AI technologies in terms of onboarding those loans onto our platform. Like I said, Inten Admin, we call that platform as Inten Admin, which we started developing in 2018 or 2019. As of today, there are around $6 to $7 billion of loans which are being onboarded onto this platform on a monthly basis. It's being used by two of the top 10 largest trustees in the US. in terms of onboarding different deals, creating reports, creating stratifications and analytics on those loans every month. So now the other part where we actually brought innovation into this workflow is around the onboarding of the loans itself. So typically what happens is when we talk about this onboarding of the loans, the issuers before onboarding the loans, they usually do a reconciliation, they do a due diligence of the loans, meaning they actually look at the loan PDF document, the original loan agreement document, and then the loan details which are being made available to them by the originators. Typically, let's say if you take a pool of 1,000 or 2,000 or 3,000 loans, it's very difficult for issuers to go through individual loans and reconcile the data. So that's why they follow the sampling process, where they probably do a sampling of 5% of the loans and look at the loan documents and loan data and then see if they kind of match each other. And this is purely an ops bottleneck, ops user bottleneck. It takes a lot of time, and because of that, they follow sampling. But now what we did is that we set up our own AI engine. We developed an AI engine which can run through each one of these 2,000 loan documents and extract specific data parameters, which can be reconciled or compared against the specific loan data to see if they match or do not match. So based on that, the issuer can actually take a call, and they can do this for the complete set of loan documents. They don't have to do any sampling anymore. So that uncertainty is completely removed, where they can be sure that they have gone through all the loan documents which they want to pool and create tranches to sell to the investors. So they can be sure about all of that. So that's one area where we actually introduce this AI so that we can create benefits for the issuer in terms of due diligence and reconciliation of documents. Now, this is what we started working in 2018, 2019, much before all of this Gen AI stuff came in, which we were introduced in the last couple of years. But the other part in the last 1 year, the other area where we are working on as far as incorporating AI into the workflow is concerned, is the fact that now that we have all of this data about the loans in a blockchain-based ledger, so any investor, after the investor actually buys into those tranches, if they want to understand what is the quality of the loan, because the quality of these loans can actually change month after month, because these are all typical mortgage loans or different type of loans where payments come in every month, or some of the payments also get missed by some of the borrowers in some of the months. So the quality of an individual loan can actually degrade or it can improve. So if I'm an investor, then I definitely want to understand over a period of time whether the quality of the loans which is backing this particular investment or instrument where I have invested, if that's improving or degrading. So now what we have done is we have actually used the Gen AI tools in terms of creating natural language processing queries which can be used by the investor to look really deep into those pool of loans which are backing their instruments. So that's another way in which we are using this AI now to build a little more flexibility or transparency as far as the loan quality is concerned.
That's very reassuring, considering The Big Short 2008 and what happened with these mortgage-backed loans, to know that there's a tool that will actually look in detail and not just take, small subset samples, and to actually share the story. And then, the institutions have the option to use the story how they wish, but at least now they have the story with transparency. Could you talk a little bit about how you open the doors with large institutions as a startup to be able to get them to even look at switching away from their highly traditional process where they weren't necessarily they don't want to break anything. Everything works. Everybody's making money. So let's just leave it alone. And you came in and, you made it faster. You made it better quality. You made it more secure. How did you engage and how did you find success there?
Right. So I think to talk about this, probably we also need to understand a little bit about how large institutional organizations work. Typically the large financial institutions. So we have worked with only large financial institutions. So these financial institutions have built processes and systems over a long period of time. So they have built their systems which have been going on for a pretty long period of time. They have their own privacy systems. They have their own technologies in place, and obviously, if you go to them and if you tell them that hey, and they work on a variety of business processes. So if you go to them and tell them that hey, I want to I have developed a product which can actually improve your life or improve your day-to-day pain points, or it can actually help you resolve some of your day-to-day pain points in this specific area. The first question they will always ask is, if you have developed something, you should not come and ask me that I need to change 20 different things in my processes or in my technologies. So as a smaller company, as a startup, or as an innovator, you'd always need to think about, I need to develop a product which actually doesn't make much changes to a large institution's workflow or their technologies or the way that a typical technology guy works in their organization. So you have to be very careful about that, because otherwise, if you go to a large organization, tell them this is what it needs, this amount of changes, the discussions get elongated and they don't come back. There are no responses to the mails and all that. So we always thought that hey, we need to keep out the product. So we have developed two products. One is Intern Admin and the other one is Intern Markets. Intern Markets is a tokenization product. But then the first principle that we always thought about is keeping it modularized. So even if it's a end-to-end product, but we actually have kept it completely modularized. So let's say, as far as Intern Admin product is concerned, one module is the onboarding part. So asset onboarding is one module. So if some institution actually wants to take up only asset onboarding and then get the data into a blockchain ledger, then probably they can use that part of the module. Now let's say the other module is about, once we have onboarded the loans, then we actually keep taking all of those servicer payments every month. We apply the payment waterfall calculations using the smart contracts, and then get some details out of it every end of every month as to what percentage of money should go to which entity. So that's another module. Then one more module that we have also worked is, if an investor actually invests in this kind of instruments, and if he wants to understand how the loans are performing every month, then there is an analytics and a stratification module which can also be taken by large institutions. So like I said, so one fundamental principle that we worked on is about this modularization of the functionalities that we provide as a product, so which is completely kind of baked into our product. And that's one way. When we talk to any large institution, we always tell them that hey, this is the overall scope of the product, but these are so many modules which are available, and probably we can talk about which is that area where you have your existing pain points, and where probably you are not able to spend too much of time as of now, because you are busy with your regular day-to-day operations and you don't have so much of technology team, or you don't have time to explore that so that you can do that efficiently. And then we start from there. So we always talk to the institutions about the point where they have the largest pain point. Of course, after we identify the right kind of institutions that we can talk to. So that's one learning, or that's one way that we usually approach the large institutions. And that's where we also, once we identify that area, then we talk about making that process completely automated. So as far as our process is concerned, we usually take the institution in three stages. In the first stage, we always talk about the fact that, hey, if you have this area and you are facing pain points in this area, can we talk about automating some of the flows in that area first? So we talk about making some of the workflows automated. In the second stage, we actually talk about, once we have automated some of the workflows, then we talk about how we integrate that, and that's where we talk about creating the blockchain ledger, because blockchain ledger, what it essentially does is it integrates the data ingestion and the processing of that, and making that available to build workflows on the top of it. And the third part is tokenization, which is where we'll probably talk a little bit about that a little later. But the third stage is tokenization. So, like I said, when we talk to large organizations, we always talk about how our product is modularized, and then we think about what kind of pain points they have, and then we start suggesting some of the automation flows that we have built in as part of our product, which can help them in day-to-day problem resolution. Once they have kind of used our product to improve their life, or probably reduce the timeline that they spend in terms of completing some of those deals, then we'll talk about creating a larger blockchain infrastructure, or bringing in more and more workflows into the blockchain platform. So that's those are few ways that we usually approach the large institutional clients. But of course, there are other areas that we always keep working with. One of the other ones is as far as the software engineering or the development process itself is concerned, we always tell them. So we are ISO 27002 certified organization. So typically, the large organizations will work with you only if you are already audited, verified.
So that's what I was going to ask. I know that these large institutions have a lot of security and compliance requirements. How was it learned, figuring out how to navigate those to kind of ensure their trust?
Yes. I mean, one part is that so they always look for companies which are already ISO 27001 certified organization. So we have, since I myself have a lot of experience in working with large IT services companies for around 17, 18 years before I started my company. So I and the other founder who was running State Street's BPO, business process outsourcing operations out of India. So he was also pretty familiar with how large IT services companies work. So we have decent amount of software engineering discipline that is baked into our system, because of the fact that we have spent so much of time in these large organizations. Typically, large financial institutions look for ISO 27001 certification. They also look at the fact that the moment you take data from them, right from the point that you take data from their system, how it's being handled, securely while it's being transmitted from their infrastructure to our infrastructure. And then once we get some of that data into our infrastructure, how do we again maintain that security in our infrastructure also? So for example, all the smart contracts that we developed and which we used as part of our blockchain platform, these are all audited by Certic. Certic is another third-party agency which actually certifies the smart contracts so that it can verify that there is no leakage of the smart contracts in terms of data. And the other part is, like I said, so we had to be extremely clear that the moment we take data from an institution's infrastructure to our infrastructure, so we We take care of it in the sense that we identify the PII. So there is this concept of PII, also privately identifiable information. So we follow industry standard practices in terms of sanitizing that data, masking that data, and then encrypting the data and maintaining that in our database. So there is a lot of focus on data integrity and data privacy when you work with this kind of institution. So over a period of time, over the last 1.5 or 2 years, so we have set up those processes as part of the product. So because of that, we have also got decent amount of traction with large financial institutions like FIS and all, where FIS is going to use one of our system in terms of and make it accessible to their ultimate clients, which are typical community banks which originate loans. So they are going to use our platform now in terms of onboarding loans and then creating instruments out of it, which can be invested by which can be made accessible to other investors. So our platform is going to be used by them for making those instruments accessible to investors. So it takes a long period of time to build that trust. So even just to give you an example, when we started working with FIS, it was around March or April 24, and we have been trying to figure out ways and means of satisfying all of their requirements in terms of maintaining data privacy for the last 1 year. And now that they have got so much of confidence in us that now we are going to roll out the blockchain-backed tokenization platform to their ultimate clients. So which is sometime in mid-June is when we are going to make it available for production for FIs. So it takes a lot of time to go through these processes, the vendor due diligence processes for these large institutions.
That sounds like a lot of work, and it's not. I think it's not something that any old startup founder could come along and kind of solve these issues. I think the fact that you've got this deep expertise that you bring to the business obviously makes it feasible for you to attack these challenges. I wonder, could we perhaps talk a little bit before we sign off about the tokenization, how you've tokenized these different assets?
Right. So, like I said, so we wanted to take all of these large institutions through 3 stages. One was automated, where we actually used the AI platforms in terms of automating the workflows. The second stage was automated plus integrated, where once we automate the workflows, then we actually take all of that data and put that into a blockchain-backed ledger so that it's available for the future. So that's automated and integrated. The third part was tokenized. The third stage was automated plus integrated plus tokenized. So meaning once we get all of the loan data or any other asset data to a blockchain-backed ledger, then we create individual tokens or digital tokens out of individual loans. So probably I can give a short example out of this. So let's say there is a pool of 2,000 loans or mortgage loans. These are typical home loans, which can be taken to a platform, and then we create non-fungible tokens for each one of those loans. So that for any time in the future, all these mortgage loans are 20, 30-year, 10-year kind of loans. Anytime in the future, if anyone wants to understand what was the characteristics of this loan, so they can always look at the NFT characteristics, the data for the NFT, and understand that this is the actual data, and this has not been tampered with, and it has been available, or it was recorded in a blockchain at such and such date in the past. So we usually created a token, non-fungible token for individual loans. And then, so for example, let's say if there are 2,000 NFTs or non-fungible tokens out of a pool, then like I said, all of those 2,000 loans can be aggregated, and 3 categories of instruments can be created out of that. In the structured finance industry, we call that 3 tranches. So superior trans and the B trans and the subordinate trans. So subordinate trans is a trans which has most risk, so that's why it has most amount of coupon available. So let's say those 2000 loans can actually be categorized into three tranches, and it can be sold to different institutional investors. And then so in the tokenized world, what we will create is three different fungible tokens. So we created individual non-fungible tokens for each one of those 2000 loans, and then we created fungible tokens to represent those three categories of loans, which will be allocated to individual investors who buys into those. So the benefit of tokenization is going to be the fact that now it's all digitally available, and it can be so if there is an investor who actually invested into one particular tranche or one particular category and got some fungible tokens in lieu of that, let's say a year later this pool is actually doing pretty well, and there is another investor who is interested in buying into this pool. He understands that this actually fits into my investment profile. Then this initial investor can actually sell those tokens to the new prospective investor, and this can be done pretty easily as compared to the offline world. And of course, the other part about this is which is also going to happen is in the online digital world or in the blockchain world, this can also be done using stable coins. In US, there are this proposal of stable coin regulation being passed. So once the stablecoin regulation is being passed, we are also going to enable this transaction happening through the use of a stablecoin. So meaning this buying and selling of the tokens can actually be done by transfer of stable coins between individual participants on chain itself, on a blockchain itself, rather than being done through an offline bank transfers. So the tokenization essentially helps in terms of creating a completely non-tamper-proof record of a particular instruments which nobody can deny the existence of, and then it also will enable the owners of those tokens to sell and buy and do that pretty easily on chain and without any amount of issues which usually you face in the off-chain world or offline world.
Thank you. This is incredible information, and it's really I really appreciate what you're in effect giving us a glimpse into the future of what I think the broader financial ecosystem will look like and must be thinking about, and how to remove some of these inefficiencies that have existed for decades. So thank you so much for coming on the podcast today. I'm sure our viewers will capture a lot of information that they can relate to their own business, especially in the world of structured finance or within finance. So lovely talking with you, and hopefully we can do this again sometime, Sanjay.
Sure. Thank you very much for inviting me. It was great talking to you.
Thank you.